Hi guys, good afternoon. So welcome back again to my channel. This is Albert with Tu-ayon and you can call me Teacher A in short. And of course, welcome for this subject, based in Math 11, Investment in Mathematics. So now, I will be discussing about the topics serial bonds and stocks. So now, I hope you are now ready to learn, understand, and listen for this discussion. All right, so to formally start of our discussion this afternoon, so now we will be defining what is serial bonds. So, serial bonds or installment bonds is describe a bond issue that must matures in portion over several different dates. So, serial bonds uh, instead of facing a large lump sum principal payment at maturity, an insurer can opt to spread the principal payment over several periods. So, serial bonds are debt in securities issued at once but mature at different dates. Okay, so the questions is how does serial bonds work? Please listen carefully for this discussion because now we will learn together how does serial bonds work. Normally, when a company or government bodies issue bonds, all of those bonds mature on the same date. That is, the borrower must repay all of the debt on one particular day. A serial bond issue, however, matures over several periods, no, and usually at a regular interval. So, during the period of repayment of the interest, so there is an interval. So, this is the example. Uh, the issuer of $100 million in traditional bonds with 10-year maturities will have to make 100 million principal payment at the end of 10 years. The issuer of $100 million in a serial bonds might structure the offering such that $20 million matures after 5 years, another 20 million matures the year after, and 20 million the year after that, and so on. So now, let's explore what is serial bonds is. So this is the example of the serial bonds, and while this is the example of the two bonds, which is serial bonds and traditional bonds issue. So as you can see, the serial bonds is something different from the other band, which is traditional band. So as you can see, the year 10, so the traditional bonds pays $100 million, while the serial bonds issue must only pay, no, starting from the year 5 until to the 10 years. So meaning to say the serial bonds, uh, this representation shows that the serial bonds has a cash savings, no? Okay, so this is the disadvantage of serial bonds. So serial bonds are not suitable when the cash flows expected to be generated by a project funded with the bonds will be irregular, delayed, or uncertain. So in such cases, structuring a bond as a serial bond could result in a default rather early in the buyback period. No, this is the disadvantage of serial bonds. So please take note that serial bonds are not suitable when the cash flows expected to be generated by a project funded with a bonds will be irregular, delayed, or uncertain. So now let us proceed to the disadvantage of serial bonds. Okay, the advantage of the issuer of a serial bond is that less interest will be paid over the life of the bonds since the aggregate amount of the cash loan to the issuer is greatly reduced, no? The advantage to this investor is the reduced risk of default since the issuer repayments liability is constantly declining, no? So, meaning to say, serial bonds is to help the issuers to reduce the risk, no, to reduce the risk of payment, no, or to reduce the risk of reduce the risk of delaying the payment, no, or the debt. So let us go on the stocks. Okay, what is stocks? So stocks is like equity financing where were about allowing money to investor to be part of the company, no? Stocks is like equity or financing about allowing money to investor to be part of the company. Okay, so there are two main kinds of stocks, which is the common stocks and the preferred stocks. So the common stock entitles owners to vote at the shareholder meetings and receive dividends, while preferred stockholders usually don't have voting rights but they receive dividend payments before common stockholders do and have priority over common stockholders if the company goes bankrupt and its assets are liquidated. So both of these stocks are dividends or share as earnings. So these are the risk consideration. So for the common stocks price and dividend may experience more volatility than preferred stocks. Common stocks also more likely to lose investment if company goes bankrupt. So for the preferred stocks, the risk consideration is lower long-term growth potential, no, and no voting rights in most cases, and generally less liquid than common stocks. All right, so these are the terminologies when we talk about stocks. So first, dividend. So what is dividend? So dividend, this is the share in the company's profit. And then dividend per share, it is the ratio of dividends to the number of share stocks. And the market, a place where stocks can be bought or sold. Market value, this is the current price of a stocks at which can be sold. Stock yield ratio, this is the ratio of the annual dividend per share and the market value per share. And lastly, the par value. So this is the per share amount as stated on the company certificate. So these are the formulas of the said terminologies. First, to get the total common dividend. So this is the total dividend minus the total preferred dividend. Then, to get the dividend per share, so let us divide the total common dividend over the number total of shares. And to get the dividend per share, we will multiply the par value or and the dividend rate. And lastly, to get the stock yield ratio, we will divide the dividend per share and the market value. So class, uh, uh, please take notes these formulas because this is very important for our discussion this afternoon. So again class, so please copy these formulas because these formulas is very important for our discussion this afternoon. So I hope you are done copying these formulas. So now let us proceed to the examples. So, example number one, a certain financial institution declared a 50 million pesos dividend for the common stocks. So, if there are a total of 100 shares of common stocks, how much is the dividend per share? Again, a certain financial institution declared a 50 million pesos dividend for common stocks. If there are a total of 100,000 shares of common stocks, how much is dividend per share? So always remember to get the dividend per share. This is the formula. The total common dividend over the number of shares. So our quote, our total common dividend is 50 million pesos and our total shares is 100,000 pesos. So this is how to get the answer. So given the total dividend which is 50 million pesos and the total shares which is 100,000. So we all know that the formula is dividend per share is equal to the total dividend divided by the total shares. So now let us substitute the given which is the total dividend 50 million and total shares 100,000. So the answer is 500 pesos. So therefore, the dividend per share in these examples is 500 pesos. So please look at the solution carefully and understand the process. Okay, so I hope you learn for this example. So now I will let us proceed to the next example. Example number 2. So a certain corporation declared a 5% dividend on a stock par value of 600. So Mrs. Lingan owned 300 shares of stocks with par value of 500. How much the dividend she received? So the given is the stock value, which is the given percentage. So dividend percentage is equal to 5%. And our par value is 600 and the number of shares is 300, no? Okay, so to find the dividend per share, so let us multiply, no? 600, which is our par value, times our dividend percentage, which is 5% or 0.05, is equal to 30. So the total dividend is 30 times 300 shares is equal to 9,000. So to get the dividend, so let us multiply the dividend percentage, the par value, and the number of shares. And then substitute the given and then simplify. So thus, the dividend is 9,000 pesos. Okay, so now I will give you the example and then I want you to answer this problem. So suppose that company X declares a dividend of 7,500,000 pesos for its common stocks and there are 80,000 shares of common stocks. How much is the dividend per share? No? The problem is how much is the dividend per share?